It is Monday, January 27th, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very casual, very early, get your ass kicked at Jiu-Jitsu Monday. Taking it easy, just a little bit easier than normal, only because I'm still kind of injured. Notice that I have a little bit of swelling in one of my hamstrings, right up there near the buttock, and or gluteus maximus, yeah, gluteus maximus, same thing. Anyway, the point being that between that and the fact that the other two gentlemen that were there this morning were both complaining that they were coming down with something, and so there's all that coronavirus going on, and you just got to be cautious with your body, right? So I did a little bit of drilling on a particular armbar setup I really like, and with the gi, I think you would probably grab a collar on it, but we didn't have that luxury, and so I just grabbed the back of his elbow instead, and by reaching over it with my opposite hand. So, I would reach over with my right hand above his bicep, and like kind of hook around over his right bicep, pull that down, and then get my leg around his head and armbar while he's still standing. And like I said, I really like that setup, so I took a little extra time and did that. We did some additional stuff on Sunday too. I stayed around a little bit longer than I normally do, although Sunday is the day that I typically get in some amount of open mat. And so I spent a little bit of time working with another gentleman that I've been training with for quite a while. I ended up getting paired with him quite a bit. And so we just worked some basic stuff, really. And I think of a couple things that I'm doing now in kind of like a systemic manner. So in the event that you have somebody mounted you, like a full mount position. And that was one of the things we worked, is I really love to get my elbow in there first. Before I do anything else, I really want to get my elbow in there. And, in between my body and their knee. And from there, you can usually set up a pretty good escape from the mount. And so we spent a little extra time working that kind of stuff. We did a little bit of side control escape and also mount escape. And we kind of walked through a little bit of variations of like the Oompa escape. Although we did it without the hooking of the ankle. I tried one thing on him, and he fell in love with it right away, where I took both my hands and I put them about where his belly button is, and I pushed out while kind of lifting my legs in, and so it got him up off of my hips, and then I used that to kind of shrimp out. I turned up on one side and then shrimped out. I've been thinking about it, and there's a lot of possibility of getting set up for like a Kimura or maybe even an omoplata from that position if the opponent that you're going up against is really good, and so maybe it's not the best setup, but like I said, we were trying to mess around a little bit and get a little bit more focus on some of the stuff he was having trouble with. And like I said, he seemed to really wanted to concentrate on getting out of that mount, getting at least to a half guard, if not full guard. And he's got a little bit of an advantage on that, and I don't think he's quite learned to take advantage of it yet, but he's got kind of short legs. And so it's a lot less effort to try and bring your leg up in between you and your opponent if you've got short legs, as opposed to the gentleman that I trained with on, I think it was Friday? Yeah, it was Friday. He was very, very long. And so for him to get a leg up and over and around my head, for things like arm bars and stuff like that, I generally had to guide myself into that situation. But yeah, all in all, I felt it was time well spent, both for him and me. It gave me just as many times, opportunities to get in repetitions as it gave him. And so, like I said, I liked that aspect of it. But yeah, this morning was almost a bust. I still got in a half decent workout. Got the heart rate up a little bit. Did some across the floor drills and drilled some moves. Did a little bit of running. So I got a little bit of a workout in. Not quite what I'm normally used to for the early morning Monday class, but nonetheless better than nothing. Anyway, let's go ahead and throw down with some music. And, we're going to start off with some body count. But exactly which song? That's always the hang-up. But I think I got it right here. 99 Problems, First Dance, here on Coin Metal. And that was Gizmachi with The Answer. So, as far as where we're going to go today, I dug up a whole bunch of stuff. And as far as our ordering, I'm trying to figure that out still, because I think it's important to order things properly. I've got a series of articles that are covering, a certain amount of territory, and I want to make sure it's all contiguous, or as at least much so as possible, right? So, let's go for this one first. And this is on ccn.com. Government-issued digital assets will be backed by Bitcoin, quant analyst says. And the author of this is Kirill Nikolaev. My apologies if I'm mispronouncing that. But yeah. So, hold on a second. I gotta blow up this picture here. Take a good look. Yes. Penis. And this is authored... When was this authored? January 27th, 2020 at 2:17 p.m. UTC. Let me inflate this a little bit. Going blind. Too many people choking me out. Not enough blood getting to my eyes. Earlier this month, the Bank of England announced that the central banks of the United Kingdom, Canada, European Union, Japan, Sweden, and Switzerland are in collaboration with Bank of International Settlements for joint research on central bank digital currencies. As the group studies the potential use cases of CBDC in their respective jurisdictions, one analyst is already thinking of the role that Bitcoin will play in the digitization of currencies. Hans Haug, a crypto asset investment analyst at Ikagi Fund, believes Bitcoin will be the number one commodity in the future. He says in the next decade it will surpass the value of a median single-family home in the United States. Petrodollar may be on the verge of collapse, says Haug. On Saturday, Ikagi's senior quantitative researcher took to Twitter to share his in-depth knowledge of the current financial system. Haug began the tweet storm by explaining how the U.S. government abandoned the gold standard in 1971. The move by former President Nixon caused the inflation rate to climb 11% in 1974. Let's see, the first one says, by 1974, inflation reached 11% in a single year. Whoopsie! The analyst then wrote that the U.S. government struck a deal with the Saudis to curb inflation. The petrodollar was created as oil purchases were settled in dollars. Over 40 years later, the rise of the petro-yuan, on top of the de-dollarization movement of the EU and Russia, are threatening the greenback status as the world's reserve currency. Hans says again, however, being permanently involved in the Middle East was not without its own consequences and complications. Fast forward to today, and we can clearly draw a line between Iraq, 9/11, and now this. China pushes back on the petrodollar. And the article says the rise of China's petro-yuan from oil futures to the world. Fiscal irresponsibility hastens the decline of the U.S. dollar. To make matters worse for the greenback, Haug said that the fiscal irresponsibility of the U.S. government has left the Federal Reserve with no recourse but to print more money to the tune of $1 trillion per year. And let's see here. Hans says, adding more strain to the U.S. dollar is that nagging fiscal irresponsibility. Don't blame the Fed for printing. They have no choice. We are currently running around 4% of GDP in the hole. That's approximately $1 trillion per year we have to print. I would wager the number is much higher than that. The analyst then explained that the only reason why the U.S. government can print more money is because of low interest rates. Haug said that once interest rates creep up, the federal government will go under. The quant researcher stressed that inflation will eventually rear its ugly head, despite the best efforts of central banks around the world to cut interest rates. When this happens, Bitcoin will save people from hyperinflation. Haug, Bitcoin to back a new world of emerging digital currencies. According to Haug, there has never been a currency that can act as a medium of exchange and a store of value at the same time. These properties make the cryptocurrency the top option for people who don't want to see their wealth vanish due to hyperinflation. Mehdi Greenspan, founder of Quantum Economics, echoed this view. He told CCN, the strictly limited supply of Bitcoin ensures that it is deflationary by design. As countries consider digitizing their currencies, Haug said it is doubtful that state-backed virtual currencies will provide people with freedom and property rights. He continued by explaining that Bitcoin is a non-sovereign asset that can settle both large and small transactions with incredible speed. It can also provide security and censorship resistance. In the end, Haug said that Bitcoin will likely act as the new gold that backs government-issued currencies. In 10 years, he predicts that the digital asset will be worth over $236,000, or $237, rather. I'm just rounding up. $1,000. There are many reasons why Bitcoin can skyrocket to over $200,000. Most of them are tied to Bitcoin's properties. Haug may be painting a doomsday scenario, but he might also be foretelling how people will revolt peacefully through Bitcoin. Yeah, I kind of agree with that. However, Here we go. Hans Hodel says, in conclusion, I see Bitcoin as the most likely candidate to back, at least in part, a new world of emerging digital currencies. Bitcoin is a censorship-resistant, scarce, digitally native asset that only needs to survive while the current system crumbles around it. And to some extent, I would agree wholeheartedly with Hans, with one exception, that at their heart, energy sources themselves have to be denominated in Bitcoin, or at least the labor to produce the devices that generate the electricity that you're using to do things with, has to be denominated in Bitcoin or other cryptocurrency. And see, I think that the additional sovereignty and agency that is given to a user of cryptocurrencies is only as functional as its inherent properties. So like with Bitcoin, sure, you could send, millions of dollars around the world but it's going to take a little bit of time. And of course, you could do it via Lightning, but that also takes up a lot of time. It would actually take you more time to set up Lightning and do it via that, because the likelihood that any third party out there would actually have the available liquidity in their payment channel to host your payment is nil. So you would end up having to pay a transaction fee and do it on chain, which means that it wouldn't necessarily be included in the next block. You might have to wait a little bit longer than 10 minutes. Now, considering that to do the same transaction with fiat currencies would, number one, require the bank's approval. And this is where censorship resistance comes in. And of course that's where LNs are kind of limited at this point, is that, again, because nobody has enough liquidity in their channel, it makes it cost prohibitive to do it that way. Because again, you would have to be setting up your own payment channel on your own hardware and making the transaction that way, or finding somebody else who's willing to host that much on their payment channel, which is like a significant security issue, mostly for your funds, or their funds rather. So it's really about what people are willing to do. And again, transacting Bitcoin on chain is very, very easy. But again, this limits Bitcoin to things that aren't necessarily like upfront retail. So if we're talking about a transaction with Amazon, or even somebody who's hosting their store on Amazon, right? That you could do the payment with them, and because of the time lag that's just inherent between when your order clears and when the order is fulfilled on their end, be they the Amazon fulfillment station or the manufacturer themselves or the distributor or somebody in between is getting the money and the product is coming to you. But there's going to be a time lag between when you make the order and when it actually gets to you. And of course that'll get shorter over time too, but we're not talking about that. All we're talking about is that because the delivery isn't immediate on the physical good, the delivery doesn't necessarily have to be immediate on the payment side. Now, of course, we do have to see the transaction follow all the way through before we put the product out the door. But after we've got first confirmation, we could probably safely deploy that package. And in the meantime, we could be getting it ready. So again, that's one application for Bitcoin where it is still a perfectly viable payment mechanism and as an on-chain transaction. But now let's take it to retail though. You've got Bitcoin Cash that'll do like zero confirmation transactions, but there has been some questionable information put out there, leads us to believe that their zero confirmation isn't 100% zero risk from double spend attacks. And as a matter of fact, double spends are still happening out there. And I happened across this one today, and I'm sure quite a few of you have probably already caught up on this one. But this is by Jack Martin. Bitcoin Gold blockchain hit by 51% attack, leading to $70,000 double spend. So, yes, penis. The Bitcoin Gold blockchain has suffered a 51% attack, resulting in over $70,000 of BTG being double spent. According to a GitHub post by James Lovejoy, a researcher at MIT's Digital Currency Initiative, the hard fork of Bitcoin was hit by two deep reorganizations of over 10 blocks on January 23rd and 24th. A 51% attack is a situation where a single entity or group controls over half of the hash power securing a blockchain. This then allows control over confirmation of new transactions and the power to reverse completed transactions, allowing the double spending of coins. 251% attacks in 6 hours. In the first attack, just after 1800 GMT on January 23rd, 14 blocks were removed from the blockchain and 13 then added. 1900 BTG worth approximately $19,000 at that time were double spent in the redirect of one transaction. Just over 6 hours later, in the early hours of January 24th, another attack removed 15 blocks and added 16. 5,267 BTG, $53,000 at the time, were double spent in 3 transactions that were redirected. Does crime pay? Bitcoin Gold uses the Equihash algorithm known as Zhash in order to remain mineable on consumer graphics cards. Based on NiceHash market prices for Zhash, the estimated cost of each blockchain reorganization attack was around $1,700. The attacker would have recouped around the same value in block rewards, meaning that the attacks at least broke even and were possibly profitable if the double spend was successfully extracted from the system. Following the attack, the price of Bitcoin Gold spiked. On January 26th, the coin moved from $10.42 to $11.60 in a matter of hours. At press time, the coin is up nearly 14% on the day to trade at $11.74. Binance increases escrow periods. At the time of the attack, major cryptocurrency exchange Binance allowed trading of BTG deposits after 6 confirmations and withdrawal after 12 confirmations. A 14 or 15 block reorganization would therefore have evaded both of these escrow periods. Binance has since increased its withdrawal requirement to up to 20 blocks, although this still does not preclude the possibility of a 51% attack being financially viable. As Cointelegraph reported, Bitcoin Gold was previously the subject of a 51% attack back in May 2018 when an estimated $18 million of BTG was overspent, leading to the coin being delisted on Bittrex. Smart move. But yeah, there you have it. This is an exemplar of the danger. And let me explain what I mean by the danger. Okay, there's this thing with regard to all of the Bitcoin transactions that are happening out there. It requires that the vast majority of the miners are playing according to the rules for those transactions to be accurately encoded in a block and verified and them issued their coins for it. However, if the number of miners, or if the miners themselves were to come under a centralized control, that centralized control could be issuing edicts for edits to happen on the blockchain that you and I are not able to stop because they have the vast majority of the control of the network. You know, they have control of the vast majority of the hashing power on the network. And so this is a danger, and it exists for all cryptocurrencies. Because as soon as the incentives to break the rules become cheap enough, somebody will fucking do it. I mean, whoever this was, they made quite a bit of change here. For $1,700, they made 2 transactions worth an accumulative amount of $70,000. Tell me the last time you made a trade like that, where you put up $1,700 and you made $70,000. If you ever have, it's been a long time. You know, I don't know. Maybe there's like some wonder trader out there that like struck gold one time or something. I don't know. Or maybe that's a practice for them. The point being that it doesn't happen a whole lot. That's a hell of a return. But the incentives became right. You know, they could afford with $1,700 enough hashing power to take over the network for long enough to do $70,000 worth of double spends. I mean, that's pretty impressive. You know, but the fact that they got away with it, it should not surprise anybody. And the same threat exists for Bitcoin. You know, whether we get there through licensing and registration and fucking edicts from some federal entity or some shit like that, or just some corporate entity who pops up a few warehouses across the globe and just blows everybody out with their hashing power. It can happen. It's happened before. But if that does happen, there's the danger that they will enforce their own rules, including editing their transactions, you know, in retrospect. And none of us would be able to do anything about it. But herein lies the rub. There's a counter to that. And it's that we can get out of Bitcoin to other currencies. And we don't have to go through an exchange or even on the Bitcoin network to do it. You send your coins to a wallet or have a wallet address printed out, sell it to somebody. That's an off-chain transaction, completely untraceable. They hand you cash, you hand them a paper wallet, it's done. And I guarantee you that that's happening quite a bit too. The funds are verifiable right there. But anyway, as far as these attacks are concerned, again, if we follow the logical path of Lightning Network and off-chain transactions being or becoming the de facto means that Bitcoin is exchanged from one entity to another, and again, these points would be used for monitoring and taxation. When that does happen, we'll be getting to a point where each Bitcoin, you know, and let's talk about it in terms of what that one guy was predicting about Bitcoin being $200,000 a Bitcoin. Could you imagine how much the transaction fees would be then? You're going to be paying like $20. I mean, at least $20. Probably way more, because from what I've seen so far, the scaling on fees is actually progressive, meaning the more Bitcoin that you have to use to do the transaction, the more expensive it gets in cash terms. Meaning, and it's not just additive, it's like multiplier, you know, like where you were doing one transaction, it would be 5 BTC or 0.5 BTC or whatever, 5 Satoshis. And then you do another transaction that's 3 times bigger. It's not 15 Satoshis, it's 17 Satoshis. You know, and then you go to 5 times bigger, and you know, it's not 25 Satoshis, it's more like 30 Satoshis. It's progressive. And it's quite progressive. I mean, the demonstration I laid out there is way more modest than the actual progression of the fee rates as it goes up. And so, you know, when we're talking about a $200,000 Bitcoin, we're talking about probably a $2,000 transaction fee. And plus, there's not going to be very many transactions being fit in the blocks because they're only 1 megabyte. And the amount of data being conveyed per transaction is only going to go up. That means each transaction will be occupying more block space. And so this is where the whole, you know, we're going to do everything off chain. That's where it all falls apart. Because in order to be able to do that, you need to be able to do that on a massive scale. Well, you can't afford to do that, not on your fucking little Raspberry node. Kiss my ass. You can't service enough transactions over Lightning Network on that thing to be part of a enterprise class transaction network. It'll like catch fire or like collapse in on its own density of its gravity or something, and just like goes supernova on your desk. So the likelihood that you're going to be handling it, very, very low. And plus, you are not going to be able to handle the transaction fees nor the liquidity requirements. Even if you've stashed like a Bitcoin on there now and you're thinking, oh, it's going to go up to $200,000 and I'm going to be able to afford to continue to establish my payment channels. No, you're not. At one point or another, the amount of Bitcoin that you've got in there is going to be eclipsed by the fees. And when it does happen, your transaction will get turned to dust and closed out, basically liquidated. And that'll be that. You don't get no money. And I'm sure somebody's wrangled it around to where it'll all settle like one Satoshi before then, or a few Satoshis like a buffer in between that before then. But the point being is that that process will make us dependent on third parties, at least third parties, maybe even fourth parties. But it'll be adding layers of cruft to the whole process of transacting Bitcoin that are not only not necessary, but would invariably be abused by the same entities that we sought to escape by coming into cryptocurrencies. We've already seen where the market is permissive of the abuse, and even the regulatory entities out there are permissive of the abuse. As I see it, stablecoins are probably the worst abuse of the market at this time. I could be wrong, but I'm probably not. Like I said, there hasn't been a single one of them that has actually gone through a third-party audit. Not even J.P. Morgan or Goldman Sachs, their projects have never had third-party audits of their liquid reserves, supposedly backing their dollars or their CBDCs or their stable coins that are currently in circulation. And so the idea that we're going to be establishing a government currency and backing it with Bitcoin, I don't know. I think the way that they worded the article, or at least the title of that article, gives the wrong impression. I didn't see anything in the text of what people were saying that actually conforms to what they're talking about. Like the guy was saying that Bitcoin would be part of a growing ecosystem. That's without a doubt. As long as Bitcoin exists, that'll be true. It'll be part of a growing ecosystem, but it won't. I don't believe there will ever be a time where Bitcoin is actually being utilized in the way that Swift is. When people talk about scale, they're talking about a minimal number of people serving a maximal number of people. And that doesn't really conform with the intent of Bitcoin. The intent of Bitcoin is that if you believe in it enough to use it as money, you also believe in it enough to be part of the network. Because it's in your interest to be part of the network. And I don't mean some fucking Lightning Network node. I mean a miner on the network. And that's a power that's been handed to us, and people have tried to cheapen it via the way they've gone about it, both in social media and just the mining sector as a whole. But there's a lot of effort to try and break mining back down to something that the average person is doing, just like hosting an Xbox or some shit like that, only you're not paying them, they're paying you. And I've talked about that a lot on this show, that I really believe that between things like regulation, which we're going to be covering a little bit of next, between things like regulation and licensure requirements on these huge mining facilities that have been popping up everywhere, because of that, it's going to disincentivize the industrial level mining, and it is going to make it to where it's more profitable for the average person to be mining again. But it'll actually be incumbent upon you by then. You know, if you've got any funds out there on any of the cryptocurrency networks, you should probably be participating in maintaining them, right? You know, whether that is renting a few AWS instances and trying to mine that way, which it's possible. Whether or not it's profitable is another story. But it is a way to get started. You know, and there are some, I guess there is some profitable mining going on that way. But it is always best to self-host. And I believe that wholeheartedly. You know, whether you're talking about your data, your mining, I think, yeah, you should be hosting your own shit. But yeah, so BTG suffering 51% attacks because they don't have enough network. Not enough to keep their coins safe anyway. But yeah, I was looking for that thing here. Iran. Damn it, here we go. And this was authored on January 27th, 2020 by Liam Frost. So yes, penis. Iran issues a new batch of crypto mining licenses, but is it too late? Iran's Ministry of Industries, Mining and Trade issued over 1,000 additional permits for cryptocurrency mining firms, according to a report by the Financial Tribune. Amir Hussein Saeed Niani, an official from the local information and communications technology sector's guild organization, said that, quote, the crypto mining industry has the potential to add $8.5 billion to Iran's economy. Actually, way more than that. As Decrypt reported in August, Iran enacted legislation that officially recognizes cryptocurrency mining as an industry in a bid to create jobs and attract foreign investments. However, the long-awaited legal certainty came with additional costs for miners, and trading in cryptocurrencies remains illegal in the country. Electrifying news. Niani also suggested that in order to help boost the mining industry in the country and generate more revenue, the government might need to modify electricity rates, noting that, quote, high electricity tariffs plus stringent regulations have made the sector less appealing for small investors. A concern for Iran is that local miners could and actually do easily move to more crypto-friendly neighboring countries, including Georgia, ranked second most profitable for crypto mining in 2018, Armenia, or even Iraq, according to Hamed Salehi, a local cryptocurrency and blockchain researcher. Speaking to Al Jazeera last year, Salehi noted that the worst-case scenario for the country would be if professional mining outfits quit the industry and their place was filled by, quote, a large network of ordinary citizens in search of easy profits using home mining devices. That's your future anyway, dude. And you've kind of set yourself on it. You know, the idea of licensing people to use their own hardware for a specific purpose, I think it's fucking ludicrous, especially when we're talking about personal computers. You know, we're not talking about CNC machines or anything that people can make guns with or anything like that. We're talking about CPUs, GPUs, ASIC devices. You know, so the idea of trying to license it as an industry, I think it's pure folly. And in the longer term, all it is going to do is force people to look for better places to do mining. It's going to be like, the electricity is cheap here, but I'm having to pay out the ass all kinds of taxes to the government just to do business here. So I'm going to look for elsewhere to go. Go to fucking Mongolia. We'll just seal up the miners extra tight so they don't get flooded the next time, they start into their monsoon season. But anyway, I think that it's really interesting to see this kind of move being performed by the Iranian government. But in the long run, I think they'll abandon it, and only because this is going to have a chilling effect on the mining industry within Iran. And Bitcoin and other cryptocurrencies are increasingly becoming a means that people utilize to circumvent things like national borders and trade restrictions. And that's just plain old citizens doing that. What happens when it becomes necessary for a government to do that? And I'm assuming at this point that governments aren't doing it, but I'm pretty sure that assumption is incorrect too. The point being is that it's happening. And there really isn't anything the Iranian government can do about it. So, bloviating about being able to do something about it and even trying to enforce those actions, again, it's only going to increase at least the perception of the cost of doing business within the Iranian borders. So, yeah, poor move. Don't do it. It's stupid. And, let's go ahead and throw back down with some music. As far as where to go next, I hadn't really thought about it. Well, we have been talking about regulation. So I think this one's kind of appropriate, even though it was made back in the 70s. It's way ahead of its time. Judas Priest, Electric Eye, here on Coin Metal. Oh, my apologies there. I was completely transfixed. Voivod, Event Horizon. So, as far as where else we're going today, I wanted to take it a little bit farther here. And where the hell did I put that thing? Not that thing. Not that thing. Although that is kind of interesting and is in line with what we were talking about. Actually, I may tap back to that one at a later time, but I've got something else planned here. Alright. And our first one back is Cointelegraph. It's on Cointelegraph, rather. And this is by Andriy Shevchenko. It was authored approximately 16 hours ago. New research shows Bitcoin-denominated payments still a fantasy. A growing precision in the amount of decimals for Bitcoin points to decreasing usage as a unit of account. This is one of the conclusions of a January 27th report by BitMEX Research, which analyzed transaction outputs for the past decade. The report evaluated a total of 1.3 billion outputs, amounting to 5.4 billion BTC, worth $12 trillion. Oh, I'm sorry, 5.4 billion. What? Amounting to what? How does that work out? A report evaluated a total of 1.3 billion outputs amounting to 5.4 spends. 5.4 billion BTC worth $12 trillion. Each transaction was categorized by its degree of decimal precision. What is the last non-zero value in a payment? Over 70% of Bitcoin outputs currently use the highest degree of precision possible of 1 Satoshi, while in 2012 this figure amounted to 40%. The report explained several anomalies seen in the chart. Bitcoin's first 2 years of life show the prevalence of Coinbase outputs which generate new coins. The block reward amounted to 50 BTC with very few other transactions. An uptick in 10 Satoshi transactions at the beginning of 2013 corresponds to the rise of Satoshi Dice, a gambling game. Finally, the anomalous spike in summer of 2015 is attributable to the July 2015 flood attack, which stress tested the network. Unit of account thesis. One of the ultimate goals of Bitcoin adoption is its usage as a unit of account where all payments are denominated in BTC instead of US dollars or other fiat currencies. However, the report explains that the continuous rise in output precision is the opposite of increasing direct usage, according to the analysts, quote, "If unit of account status is achieved or becomes more prevalent, then presumably the degree of precision should reduce rather than increase." Several factors are identified as potential causes. One is the experimental use of Bitcoin in its early days, which included users testing their first coins or on-chain gambling and gaming. As exchange markets and usage matured, the analysts argued that a higher degree of precision became necessary. Despite the rise in the Bitcoin price, one Satoshi is still worth less than 1,000th of a cent. It appears unlikely that fiat-denominated payments would require such an extraordinary amount of precision. Transaction fees could play a part in this. The change returning to the sender in a transaction usually has a higher precision due to the need to subtract the fee, which is calculated in Satoshis per byte. The report highlights this as a possible privacy improvement. As the amount of high-precision transaction increases, it becomes more difficult to understand which part of the actual money sent and which is the change. The analysts divided Bitcoin into 3 adoption phases. Number 1, medium of exchange, 2, store of value, and 3, a unit of account. Noting that even the first step of medium of exchange is still ongoing, they concluded, at least for now, the unit of account status is still somewhat of a fantasy. I agree and disagree, only because the block size has been artificially limited at 1 megabyte. But yeah, anyway, let's scroll up here. There was something I wanted to check out on this chart here. And it's a list of all the transactions that have happened, or it's a graph demonstrating the volume of transactions per type of transaction. It's kind of interesting. Let's see here. What is that? I was trying to find something specific on you. Here we go. The report. Let's see here. And yeah, why not? Let's do this report. Let's see how long it is first. We may. Yeah, why not? It seems short enough. But I've got other stuff I want to cover, though. So let's do that first, and then we'll worry about going back to that. But yeah, the nature of the change of Bitcoin, I would say that what you're seeing is the result of coercion in the market. And it's one of the reasons why I believe we'll actually see another proliferation of altcoins. Because altcoins that currently exist will probably be regulatory compliant in some way or another, or have hitches on them. And not all of them, I would say. There's plenty of them out there that don't. But many of them will have points that they can be hit on. Where they have dedicated mining, or delegated mining, where the mining is delegated to only certain entities. Those entities are a lot easier to hammer down on than an ad hoc network of free individuals who are free to jump on or jump off at any time. Anyway, so this next one here I got on Forbes.com, and this is authored January 25th, 2020 at 10:01 a.m. And it was by Billy Bambrew, and yes, penis. There's something very strange going on with Bitcoin exchange, Local Bitcoins. Reports began coming in this week that local Bitcoin users across Africa, the Middle East, and Asia have had their accounts deactivated. Messages seen by this reporter were sent to account holders by local Bitcoins in countries including Afghanistan, Iraq, Nigeria, Syria, and Pakistan, informing them that they could withdraw their Bitcoins by deleting their account, though some users have claimed to be unable to do so. Local Bitcoin, a peer-to-peer Bitcoin exchange, which was founded in 2012, is headquartered in Helsinki, Finland, was unable to be reached for comment. Quote, "One of my customers was due to travel out of the country and had some to sell of his Bitcoin to be able to go, only to notice on his way to the airport that he cannot even access his funds," said one local Bitcoin's user of 3 years in Nigeria, who wanted their identity to remain anonymous, adding their account had been suspended on Monday morning with no indication of when it might be reactivated. According to the message received by users, Local Bitcoins now requires users in some countries to go through an enhanced due diligence process, though Local Bitcoins has given no indication of what that process is or when details will be made clear. Some reports have suggested that suspensions are a result of strict new European Union anti-money laundering regulations that came into effect this month, requiring Bitcoin and cryptocurrency platforms and wallet providers to identify their customers. However, Local Bitcoins, which has a reputation as being a relatively anonymous way for Bitcoin users around the world to buy and sell Bitcoin, claimed to have complied with the new legislation early last year, giving it ample time to verify users' identities ahead of the changes taking effect this month. The regulatory changes have been blamed for Bitcoin trading volumes on Local Bitcoins falling sharply in recent months, with reports suggesting Bitcoin volume on the site fell around 70% between September and November 2019. In an interview last year, Local Bitcoin's chief executive, Sebastian Sontag, said the exchange was signing up between 4,000 and 5,000 new users per day, but warned, quote, "changes to the site have had an impact on overall trade volume." Quote, "We expect the situation to become more stable in the following weeks, and improvements in the verification flow should also influence positively," Sontag told finance trade site Learn Bonds. Meanwhile, other major Bitcoin and crypto exchanges have been struggling with declining volumes over the last year, sparking fears that the market could be on course for a correction. Bitcoin and cryptocurrency exchanges around the world have long struggled with hacks, data breaches, and thefts, with many millions of dollars worth of Bitcoin and other cryptocurrencies lost. Last year, hackers stole around $28,000 worth of Bitcoin from users' local Bitcoin's accounts. So yeah, that's the danger of having a third party facilitate your transactions. And we want exchanges, we need exchanges and whatnot, but there is the possibility at any one time that this could happen to you, no matter who you are or where you are. So it really pays to try to set yourself up to where you're not dependent solely upon such on-ramps and off-ramps into the crypto space. Things like mining. If you're a miner, It's a lot easier to come by an in and an out. Because the in is you, and there are plenty of outs. But yeah, I got this next thing here, and it was authored on January 26, 2020 at 9 a.m. And let's see here. This is on Forbes.com, and it's by the Forbes staff. No clarification there. Happy Lunar New Year. Bitcoin volume expected to plummet. JP Morgan spinoff launches hybrid blockchain. Blockchain. This is why I always ask what people are talking about when they say blockchain. Because I'm sure there's some assumption that people are talking about Bitcoin. But that could just as easily be some private database. Anyway, continuing on. Crypto markets. Bitcoin gave up some of its January gains this week as it fell 10% over a period of 7 days after climbing above 9,000 last weekend. On Thursday alone, the digital asset lost 3.6% in a matter of hours. While the cryptocurrency might face additional losses in the short term, Tim Enneking, managing director of Digital Capital Management, said that in the long term, he's looking for Bitcoin to bounce back. The downward corridor of the past 6 months has been pretty solidly broken to the upside, he said. Expect volatility for the year of the rat. Bitcoin traders and investors have been warned to expect Bitcoin volatility this weekend due to Lunar New Year's celebrations in China. The year of the rat starts this weekend. Time for Bitcoin volatility and volumes to nosedive. Arthur Hayes, the chief executive of the Seychelles-based Bitcoin and cryptocurrency exchange BitMEX, wrote on Twitter. Earlier this month, crypto analysts warned Bitcoin trading volume is now at its lowest since April, with the volume down 90% from its June 2019 high. When volume is low, markets are more likely to make sudden volatile movements. Enterprise blockchains see developer boom. According to a new study by the Singapore-based blockchain startup ChainStack, the number of engineers in the open-source enterprise blockchain space working on platforms like Hyperledger Fabric, Quorum, Corda, and others has grown by a factor of 12 over the last 3 years. The report reveals a story of how some of the larger corporate-backed protocols have fared well in the market while others, like Hyperledger Sawtooth, have declined, though it should not lead to the conclusion that a robust development community is a proxy for enterprise blockchain adoption. That still remains to be seen. JP Morgan spinoff launches hybrid blockchain. Brooklyn-based blockchain startup Kadena, founded by 2 JP Morgan blockchain alums, launched a hybrid blockchain last week that is designed to give enterprise world access to the power of public blockchain while retaining the privacy that comes with a private chain. I don't see how you can do that. The founders say the new blockchain solves the known scalability issues of proof-of-work networks like Bitcoin and Ethereum. Read more here, which we may in fact do. Elsewhere, central banks join forces to look at digital future currencies. Okay, let's see here. Let me see if there's any comments on this one. No, apparently not. And yeah, so that's not really all that interesting. What these guys keep forgetting is that the security is from people like you. The demand for Bitcoin or other cryptocurrencies is from people like you. So if they kick you out of one end of it, why are you going to be interested in the other end of it? Not going to happen. Let's see, when did this thing come out? This was January 23rd. JP Morgan spinoff Kadena is bringing scalability to blockchain. And this is by Oluwaseun Adeyanju. So yes, penis. I'm going by the picture too, so take the mystery out of it. Brooklyn-based blockchain startup Kadena launched its hybrid blockchain on January 15th, a key step toward giving the enterprise world access to the power of public blockchain while retaining the privacy that comes with a private chain. The company, founded by Stuart Popejoy with Wilmot Martino, who worked on the blockchain team at a multinational financial services firm JP Morgan Chase, says its hybrid blockchain solves the known scalability issues with proof-of-work networks like Bitcoin and Ethereum. Quote, Kadena mainnet is a scaled proof-of-work mainnet. The key here with this launch is that for the first time ever, we figured out how to have a scaled proof-of-work network. We figured out how to shard proof-of-work, Martinez said on a phone interview. The main components of the Kadena hybrid blockchain include the company's private chain, dubbed Kuro, a public chain, and Pact, its open-source smart contract language. Pact is a human-readable smart contract language that Martino says lawyers with Microsoft Excel level of programming competence could use to write contracts and publish them on the blockchain. Why hybrid blockchain is needed. One of the promises of blockchain is to cut out unnecessary intermediaries in business processes. In card payments, for instance, that might include the acquiring bank, issuing bank, and payment networks. If enterprises are ever going to enjoy the low friction that blockchain brings to transactions, they will need to connect to a public blockchain. By running on a private blockchain, enterprises, quote, have only substituted one intermediary, financial institutions, for another. Software companies and hosting organizations, Ernst & Young's global blockchain leader Paul Brody wrote in a CoinDesk column. The challenge, however, has been that public blockchain comes with a host of privacy concerns, some of which may even make certain companies non-compliant with regulations. In some other cases, it's a problem with how using a public blockchain would require companies to share sensitive information publicly. Yeah, in an encrypted packet, for Christ's sake. A few projects are seeking to connect enterprises to public blockchain networks without compromising on privacy. Quorum, a blockchain that's built based on Ethereum, is one of those projects. There's also Besu from Hyperledger, a consortium dedicated to connecting enterprises to public blockchain networks. Besu is essentially a codebase that connects businesses directly to a public blockchain, starting with Ethereum. Outside of Ethereum, proof-of-stake blockchain platform Waves is also working on a solution called Gravity Hub that would potentially connect different blockchain networks, including private chains connecting to public chains. Gravity Hub solves the problem of scalability and also allows us to get data from other blockchains, including private chains and the real world, solving the so-called, quote, oracles problem. Sasha Ivanov, Waves CEO and founder, said, quote, Gravity Hub aims to allow enterprises with private chains to share only necessary data with the public chain, which we archive using interchain bridges. The company says Gravity Hub is a blockchain that doesn't have a token but can interact with other blockchain platforms, including Ethereum. Okay, so what is the incentive model for the miners that are mining Gravity Hub or mining Gravity Hub's blockchain if there's no incentive to do so, i.e. tokens cryptocurrency. Continuing on. The Cadena network appears to be doing things differently in that it aims to be an end-to-end solution for connecting enterprises to a public blockchain. The company wants enterprises to build applications on its own private chain instead of building from scratch and create smart contracts on its public chain that allows users to interact with those applications. It's important to note that the Waves platform has both public and private blockchain as well. It offers its public blockchain services through Waves Enterprise. The difference is, unlike Cadena, both chains aren't part of the same network. With the introduction of Gravity Hub, however, its private and public blockchain platforms could become interoperable in a similar manner to Cadena's hybrid chain. A different approach to proof-of-work blockchain scalability. Despite blockchain networks Bitcoin and Ethereum, which are built using proof-of-work protocol, being the two most successful blockchain networks, they still take a longer time to verify transactions than the traditional digital transactions. Based on the data for the Bitcoin network available at blockchain.com, the network completed an average of 3.8 transactions per second over the last 1 year. Ethereum, on the other hand, is widely estimated to complete 15 transactions per second. Both of these figures are meager for a technology that seeks to upend the traditional financial system. Visa alone can process up to 1,700 transactions a second and up to 65,000 transaction messages per second. Clearly, blockchain needs to support several more transactions to be anywhere close to competing adequately with traditional processors. The problem with proof-of-work blockchain networks, however, is that they're computationally demanding and process transactions linearly. The demand for high computing power exists to discourage network attacks. However, that has made proof-of-work blockchain notorious for its enormous energy consumption. To understand the linear throughput problem, consider a scenario where you have to fill 1,000 boxes with books and then load the filled boxes onto a truck. Assume that each box can take 20 books. Doing the work alone would take more time than having 9 other people helping out, even if you were to get bigger boxes that could take more books at a time. That's incorrect. Right there, that's incorrect. The limitation on the transactions per second is calculated based on the block size. The available block size. Anyway, continuing on. Even if you were to get bigger boxes that could take more books at a time, proof-of-work networks like Bitcoin and Ethereum are like the fellow who chooses to fill the 1,000 boxes all alone linearly. And that's not entirely true either. Everybody's doing their shit linearly, or should be anyway. The Cadena blockchain is designed to be the fellow that calls 9 other friends to help out, each packing the boxes at the same time so more can be achieved in a shorter period. The blockchain startup achieved this by creating a blockchain with the potential to contain several other chains that can be mined in parallel. Oh, great. So it's just an overlay protocol for mining then. At launch, the Cadena blockchain has 10 chains, but it can increase limitlessly along with network demand, according to Martino, who added that his team plans to upgrade the network to run between 20 and 100 chains within the next 3 to 6 months. Quote, each chain has a dedicated amount of throughput that is somewhere between 10 and 100 transactions per second, depending on exactly what you're doing, said Martino. Then we have 10 chains, so you can multiply it out. Instead of it being 10 to 100, it's 100 to 1,000 transactions per second. Doing the math for 100 chains, transaction speed could be in the range of 1,000 and 10,000 per second. What? Big whoop-de-doo. So they're just adding more chains. They're not actually increasing the throughput. They're just adding more chains. That's like your processor. Several channels running at 66 megahertz, but cumulatively it looks like 1.8 terabytes or whatever it is, terahashes, whatever. The principle of sharding that Kadena has employed to create multiple chains on a proof-of-work network is popular among proof-of-stake networks. Proof-of-stake is a competing consensus algorithm tipped to solve the computational intensiveness and linear throughput issues with proof-of-work. The Zilliqa network employs sharding. The Ethereum network is working on an upgrade to transition to the proof-of-stake algorithm. Nervos, another proof-of-work powered network, also has multiple chains in a network. Waves say it's also working in implementing the sharding technique. Kadena differs from these other networks in that it's a one-layer network, whereas these other networks employ a two-layer approach, according to Martino. Quote, I believe we're the only people to have actually successfully sealed Layer 1 in a fundamentally innovative way. We figured out how to have 10 main ledgers in one single network, and that's the key difference here. Better onboarding for dApps. Kadena also claims to have fixed the onboarding issues that have plagued blockchain networks. Despite the growth that Ethereum is seeing with decentralized applications, dApps, it remains the favored network for developers. The adoption of dApps continues to be limited by a fundamental user experience issue. New users need to first jump through the unfamiliar and technical hoops of learning how to use a crypto wallet and buying some crypto before they can try a dApp. An Ethereum community solution called Gas Station Network currently seeks to solve that problem. Martino said Kadena supports gas stations out of the box through an update to its smart contract Pact. Enterprise use cases. Presently, Kadena is working with enterprises including US-based USCF, an alternative investment product provider, and Remedy, a startup that develops blockchain-based healthcare applications, according to Martino. The USCF is developing financial products on the Kadena private chain and will use smart contracts to allow consumers to access it through the public chain. According to Martino, USCF believes that hybrid blockchain could be the backbone of the next generation of exchange-traded funds. Quote, while we've seen the concept of decentralized finance come out the Ethereum side, it can also be approached from a traditional finance side, and that's what the partnership that we have with USCF is about, providing the next generation of ETFs that spans both traditional crypto systems, said Martino, who couldn't provide deeper details because the project is at a sensitive time regarding regulatory compliance. In other words, it's not compliant. Remedy, on the other hand, is working on a pilot with the U.S. Food and Drug Administration, as well as an application that tracks CBD oil from farm to consumer table. The pilot with the FDA is to build an application that collects real-world evidence or data on healthcare products using blockchain. Real-world evidence plays an important role in the FDA's decision to expand patent protection on products. According to Martino, building on a hybrid blockchain makes it possible to have a public data marketplace for real-world evidence in a compliant way. they're already compliant. The problem is you keep trying to force them into the same frameworks that fit for fiat, and it just doesn't work out. Blockchain community support would be important, although you probably will never get it. Kadena might have tried to address some of the most pertinent issues with existing public blockchain networks. However, many other blockchain networks before it claimed to have fixed the same issues. Still, Bitcoin and Ethereum continue to lead. Regardless of how scalable and secure the technology is, Kadena will need to pull in large network support to challenge the leading networks. Only time will tell how it's able to do that. I would suggest that they probably won't be able to, and that this will be one of the things that gets added to the trash pile of stuff that regulatory compliant entities have tried to do to interface crypto with their dealings. And it always fails because they can't develop market support for it, i.e. they can't develop your support for it. And I strongly believe that this project will probably be no different in that regard. Anyway, let's go ahead and throw back down with some music. And I've been dying to play some 12-Foot Ninja, and for whatever reason, I've just not managed to get around to it. And so, let's go ahead and do that. And as far as what song, though? Silent Machine, here on Coin Metal. For some reason, this program is just not letting me play Skindred, and it's kind of hanging up on me a little bit, which I'm surprised with, honestly, because, I just had a massive upgrade on my pewter, and it would seem to normally kind of like cut this kind of activity down on my pewter. But, maybe we're not 100% out of the woods yet with regard to all that. I don't know. It seems alright so far, although, despite the glitching, and maybe we'll actually get out of this episode with a last dance. Hopefully. We're going to try. And, so yeah, it is with that I'd like to bring this episode to a close. Thank you very much for listening. I certainly do appreciate it. We will be back again on Wednesday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe, do your homework, and watch out for your own bunghole, because nobody else is going to do it for you. And as far as our last dance is concerned, I hadn't selected one, but I think this one, there's just enough time for this one, so Got the Time by Anthrax. Last Dance, here on Coin Metal. Thank you again for listening, and you all have an excellent evening. Good night.